Hi, my name is Dana Golden. Today I'm going to talk about imperfect information and insurance markets. So, why is insurance relevant in environmental economics? Climate change increases the likelihood of natural disasters and the need for insurance. You're seeing this real recalibration of risk globally as everyone learns to deal with this increasing frequency of global disasters and this increasing problem of climate change. Also, insurance models give us a way to assess the risk of climate change. Obviously, climate change is going to be very bad. But there's a little bit of uncertainty about what the actual effects are going to be. So it's useful to have a model of thinking about making choices with uncertain results, particularly even if you're not able to stop climate change, if you're trying to prevent the effects of climate change or mitigate the effects of climate change, it's useful to think about how you should deal with that risk, and insurance gives you a really great way to do that. And also, imperfect information is a real-world condition that raises the cost of regulation. I personally think that models of imperfect information are probably some of the best things to come out of economics, because this is a real issue in the world that economists have come up with a very valuable framework to deal with, and I think the field should be lauded for that. And often the answer to why people don't do anything about climate change is insurance. There's this weird moral hazard problem where people are insured against risk. And until you understand that, you're going to wonder, why aren't people moving? Why are people staying in these very weird places? And sometimes the answer is that it's this weird socio-political cultural problem where it's hard to move, and the jobs are in unsafe places. But also a very common answer to that is, well, actually someone's absorbing the risk to make it easier to take on more risk. So here's a map of the prominent risk to climate change. There's a risk everywhere. There's no place in the entire United States and no place in the world that doesn't have some risk of climate change, and the risk vary across countries, and it's going to become more prominent over time. So yeah, it's right here, if you'll notice, we're on Long Island. We're very susceptible to hurricanes. We haven't had a big one since I've been here. I moved here from Kansas City a few years ago. Extreme heat was a bit of a problem in Kansas City, but now we're going to be very susceptible to hurricanes, and storms like Sandy are going to become the norm. So it's important to think about this risk in a systematic way that you can because of economics. So it's a hypothetical. I like to do this when I talk to people about insurance and risk in economics. So I think it's valuable to understand that sometimes there are impacts of risk that might not. I think a lot of people think it's just about expected value. It's not just about expected value. It's also about variance, but it's not even just about expected value and variance. It's also about losses and gains. And I think people point to these things and say, well, these people are acting irrationally. When actually, it can be very rational to have a self-preservation instinct that a lot of people just express. So would you rather have $10 with certainty or $20 with a 50% chance and 0 with a 50% chance? I kind of think that almost everyone in watching this video kind of has one answer to this question. It seems really unlikely that anyone has a different answer. I think we all very obviously understand what the answer is. If If you haven't thought about it, think about it for a sec, and then I'll give you what my answer would be and what the rationale is. So yeah, my answer is I want the $10 with certainty. These two bets have the same expected value. I would like to know that I'm making the $10. And I think most people would. I think most people don't like risk and try to avoid it in their daily lives. So what would I need to pay you to be indifferent? So this is a question that is central to the models of insurance markets and perfect information is if I paid you some amount with certainty, what would that have to be to make you indifferent between these two things? To say, I don't really care. This is called the certainty equivalent. And, in general, there's some amount that you can add to a risk to make people indifferent between receiving that amount with certainty and and a particular gamble. Would you rather have a 50% chance of winning $100, a 50% chance of losing $10, or a 50% chance of winning $60 and a 50% chance of winning nothing? So this is another interesting one. I want you to take, let's say I'll give you about 10 seconds to think about this. Yeah. So my answer is obviously, I think I just want the 50% chance of winning $60. So notice the expected value of that gamble is $30. The expected value of the other gamble is 0.5 times 100 plus 0.5 times -10 equals 45. So 45 is clearly more than 30. 0.5 times 60 is 30. So one gamble is going to give you 30, and one gamble is going to give you 45. It's pretty clear you want to take the gamble of $100, but I don't like the possibility that I'm going to pay $10. This is not irrational. There are economic models that can deal with this, and actually I think probably most people would prefer to not have the potential to lose money because losing feels bad, and also losing can be significantly worse than winning. People are risk averse and loss averse. The more money you have, the less money matters to you. And also people would prefer smaller potential upside if they can mitigate potential losses. So let's just do a quick review. Utility functions are a mathematical representation of consumer preferences. In this case of insurance, their preferences over different levels of wealth. Consumers prefer a certain outcome over a gamble with the same expected wealth. That's risk aversion. It's an assumption we tend to make. There's not many economic models that focus on people who like risk, but it is very possible to have people who like that. And there are some cases where I think, if you were in that situation, you or I would also say, I think I would take this risk. I would like risk here. So, there are several common utility functions that have different values of risk aversion. First off is linear utility. This institutes risk neutral. This means I don't care about risk. I just care about expected value. I just care about how much I'll make on average. Quadratic utility is basically at some point more wealth will actually make me less happy. So this is kind of an odd function, but you do see it. It does make sense in some cases. And then logarithmic utility, and this is what we're probably going to use almost entirely for risk, which provides the diminishing margin utility of money. And this is the idea that you always like more money, you always like more wealth. But if you're a billionaire, do you really care about 10 extra dollars? If you're poor and you only have $1,000 to your name, that 10 extra dollars makes a difference. If you're Bill Gates, you're not going out of your way to make $1 billion. And that's possible with even the same preferences. It's just, people who have more money don't really care about making even more money because it's a smaller percentage of their wealth. So in insurance economics, we tend to talk about von Neumann-Morgenstern utility theory. This is a framework for expected utility under uncertainty. It's really not that different from traditional utility. The biggest difference is now, instead of like having utility in terms of like a basket of goods, you have utility in terms of wealth. And also, because we're going to be dealing with probabilities here, because we need a little bit of an understanding of probabilities, now it's linear in terms of probabilities. So you can have the value of utility is just the sum, or the expected value of utility is just the sum of, it's just the expected sum of the utilities. So here, expected value of U of W is equal to the sum of probability of I times U of W. I should notice that, like, I'll mention this more in a moment, the utility of expected wealth is not the same as the expected utility wealth, even in this framework. They're very different things. If I give you the expectation of money, that's not going to equal if I give you the expectation of utility, because money at different levels of wealth is going to have different effects on utility. So we have the same actions as before. Preferences are complete. Preferences are consistent. Preferences are independent of irrelevant alternatives. That's the new one. So yeah, that's the big difference here, is that preferences are independent of irrelevant alternatives. I won't focus on it that much. All this means is that if something's not available to you, or if I introduce something that's going to be the same in both states, you don't really care about that. So yeah, and then preferences are now continuous over probabilities rather than continuous in space. Expected value, this is just going to be a quick review of probability theory. I'm not going to get too deep. I just want to make sure we're all speaking the same language. If I have x is the sum of I, p of I, times x of I, where x is a random variable, x of I is the possible outcomes, p of I are the probabilities of outcomes. The variance of x is equal to the expected value of x minus e of x squared, equals the sum with respect to I of p of I times xi minus e of x squared. So basically it's the difference between the expectation squared and the expectation of a variable squared, like e of x, and then all of that in parentheses squared, and the expected value of x squared. Standard deviation is the square root of the variance. Expected value represents the average expected loss or gain. Variance and standard deviation measure risk and uncertainty. Application insurance markets. Risk-averse individuals are willing to pay a premium to avoid uncertainty. Insurance transfers risk from the individual to the insurer. Actuarially fair in premiums means that premium is equal to or greater than expected loss. So the insurer is expecting to make more back than they put in. And this includes, in our model, at least in the way we're talking about, it should include administrative costs and profit margin in real markets, so that insurers want to be in the market. We want to make sure that, like, an insurer's not going to say, why am I here if I'm just going to lose money? So actuarial fair means that the insurer is not incentivized to just leave the market and not offer any contracts. So maximizing the expected utility means that you're maximizing the expected utility of wealth, not the utility of expected wealth. It means you're maximizing the probability of each outcome times the utility of that outcome with respect to all utilities. And in this case, notice how we have this premium here, this pi. Pi is the premium, and then L is the loss if the outcome occurs. So there's some probability P that some event is going to occur. In this case, think of this as a flood. So we're modeling floods with some probability the flood's not going to occur, and you're going to be fine. You'll be like, why do I need insurance? By the way, insurance only really works well if you don't use it. Turns out that if you never have to make a call to the insurance company, you're going to feel like, gosh, I wasted all my money having this insurance. You need to see the counterfactual. Never having to call the insurance company is generally a good thing. So 1 minus P, there's some probability that your house will be fine, and then you'll just your utility will be the utility of your wealth minus your premium, and then there's some probability that a flood will occur, and you'll really need this insurance. You'll need this insurance company, and then the expected utility is 1 minus the probability of you being safe plus the probability times the utility of your life in the case of the flood, which is wealth minus the premium, because you're paying the premium either way, minus the losses. There's some loss you experience, plus the insurance payout. And in most cases, the assumptions economists make about utility mean that insurance contracts tend to want these things to be equal. Almost always in these models, the answer is that you want to set W minus pi minus L plus I equal to W minus pi, and then you want to set pi so that it's actuarially fair. That tends to be what we see in economics models. Just some quick additional stuff. You can probably skip over this. I won't test you on it, but I want just to introduce it so you'll have a way to talk about risk. First order stochastic dominance, a distribution F, first order stochastically dominates distribution G, if f of x is less than or equal to g of x for all x with strict inequality for some x. So all this means is that you have two cumulative distribution functions. The cumulative distribution function is the integral of the probability density function. It means the probability of a value being less than or equal to something. So here, the distribution f of x is always below the distribution of g of x. And all that means is that for all values, the expectation of f of x is greater than the expectation of g of x. You would always prefer f of x regardless of risk preferences, as long as you don't. Regardless of risk preferences, you always would prefer f of x because f of x always has higher expectation, and you like higher expectation. So implication, all individuals prefer f over g regardless of risk preferences because f of x always has a higher expected value than g of x because the cumulative distribution is lower. So second order stochastic dominance, second order stochastically dominance G if the integral of f of x dt is less than or equal to the integral of g of x dt for all x with strict inequality for some x. All this means, you're not going to need to know the math. All this means is that if a distribution second orderly stochastically dominates another distribution, if f of t second order stochastically dominates g of t, all that means is that the expected value is at least equal between the two, and the variance is always less. So all risk averse individuals prefer f over g. So if you're risk averse, you always prefer f because it's lower variance and then potentially equal mean. Insurance policies can change the distribution of wealth, and risk-averse individuals choose insurance to achieve preferred wealth via distribution via second-order stochastic dominance. Yeah, so there are three types of utility functions. What is risk averse? This is what most of us are, even if we don't like to think of ourselves that way. Risk averse means that your utility function is what's called concave. It looks like a cave. It's like bending over backwards. It looks like a cave. And then risk neutral individuals, this is what we think of as companies or as public traded companies. It's linear. It's just going straight up. And then risk-loving individuals, it's convex. You prefer a lot of money with a low probability to a little bit of money with a high probability. You would like to take big risks. I would say the people in Silicon Valley are mostly over here. Mostly they like this. Elon Musk, Sam Bankman-Fried, Sam Altman, 100%, all of them are right here. And I think that probably says a lot about how AI is designed. The rest of us are all over here, and we buy insurance. So a certainty equivalent is the amount of money given with certainty that equals a gamble. A risk premium is the difference between the expected payoff and the certainty equivalent, the price of risk, I have to pay you to take a risk. And an actuarial fair premium is an insurance premium set at a price that exactly equals the expected payout an insurer will make on a policy. So Jensen inequality for risk-neutral individual, the expected utility of wealth is equal to the utility of expected wealth. For a risk-loving individual, the expected utility of wealth is greater than the utility of expecting wealth because you just really, really want to take the risk. So those high outcomes really are more preferred to those low outcomes. And for risk-averse individuals, where most of us are, the expected utility of wealth is less than the utility of expected wealth. In general, I would think it's a safe bet to assume everyone is here. That means mathematically, that means their utility is function concave and that they don't like taking risks. But there are people who are here, and almost all companies are here. Because of this, between risk-neutral insurers and risk-averse agents, a contract always exists to improve welfare to both parties. Think about this for a moment. It's a kind of an counterintuitive result. There's always a contract that can exist between a risk-neutral insurance company and a risk-averse individual, where the risk-neutral insurance company will take on some of the wealth potential from the risk-averse individuals. Think about this. I'll give you about 5 more seconds. So yeah, the reason this is because the risk neutral insurance companies have this linear line. The risk-averse individuals have this concave line. And so if I offer you this, the expected utility of wealth, if I offer you this, the money that gives you the expected utility of wealth, with certainty, you'll always prefer that to the gamble. So you can just give me the gamble, and I'll give you enough money to make you whole regardless of the outcome. And that allows insurance to always exist. So it's a really nice result that as long as you have linearity of utility function, even if you have like heterogeneity in risk aversion amongst individuals, you can always have it so the insurance company is willing to give a contract that the individual is willing to accept. Here's concavity. Once again, concavity means that an insurance contract exists. This is plotting the opposite thing. This is plotting payoff and risk. So this is why that looks different, because before we were plotting the amount of money with utility. Here we're plotting the risk versus payoff, and here's what a concave function looks like. This is like how the utility function that's concave looks like there. So now we're going to take a break, and then I'm going to work a flood insurance problem.